Hi everyone, welcome to the Buffett and Beyond Research Saturday ETF report, and this week we're going over how to hedge this correction and what we do about it and what we're going to talk about. And this is March 8th, 2025. Remember, if you want to live on the beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let us look at some nasty charts in here. And this first one is the Dow, and we can see the double top in the Dow right up here. And now we're seeing this correction. Down here is the 20-day moving, 200-day moving average, and we're approaching that rather quickly. And we can see our intermediate term indicator down here. And this is what gave us a sell signal, because this double top in here and then this top in here was declining. So in other words, the market reached the same high as it did back in here. And this time when it reached that high, this indicator with the sloping down line did not reach as high as it was before. So that was the giveaway on that, okay, we're doing some topping in here. And this indicator, intermediate term indicator, has been down ever since. Now let's look at the SPYs, and the SPYs mimic what? They're 1/10 of the S&P 500. We see the same thing in here. We did reach a higher high, but this indicator reached a lower high. So there is that same indication as we saw on the Dow. This SPY, which is a mimic for the S&P 500, is trading at its 200-day moving average. In fact, as I'm recording this midday on Friday, it is sitting below that 200-day moving average as we speak. Notice here these red lines, that the red lines represent the volume on a down day, and we can see that in here it is lower than here, so the volume seems to be drying up. Here we don't have a full day yet, so this doesn't count, but we like that drop off in the volume on the down days. So the market looks nasty, but as you're looking at the internal, and these are just 2 points, so we need more than that, so but it's a good sign anyway. So we'll see what happens around this 20-day move or 200-day moving average. Now, when we look at the QQQs, which are what? The NASDAQ 100, and pretty much represent the NASDAQ, we see it is trading just as the NASDAQ is, down below its 200-day moving average 2 days in a row. So that's not a good sign. We don't like to see that. But again, the volume is drying up in here, or at least has for the 2 out of the past 3 days. Now, let us look at the QQQs and the S&P 500. And the S&P 500 are the black lines in here. And this looks larger because it's just the past couple of months. So we see that the S&P from its high, not yearly, but from its high, started about a little bit more than 1% above right in here, and it is now about 6% down. So we're looking at about a 7% move in the S&P 500. Now the QQQs represented also doing the same thing as the NASDAQ index is, but the QQQs are the NASDAQ 100, but they move pretty much the same. We see it started at a +3, and now it's down almost to -8. So we're looking at about 11% move to the downside from its high. So we're looking at maybe 7% on the S&P 500 and 11% on the QQQs, just to give you an indication of what's happened over the past couple of weeks. Now, let's go to our Sector Stars All Model portfolio, and now this is based on the year. For the year, it is the QQQs are down 4.8%. The S&P is down 3%. Our portfolio, which moves a lot faster than either one of those, is down 7.8%. So we're looking at that and saying, okay, we expect that. And that's the, I don't know if we want to call it a problem, but it's a problem on the downside, but boy, is it wonderful on the upside. Now, don't forget, last year, this portfolio was up 36.4%, where the market was up just 23%. So we expect more downside action than this. So again, the QQQs are down almost 5%. The stocks that we have in this Sector Stars portfolio is down about close to 8%, or 7.8%. Now let's go to our NASDAQ 100 stocks, which is my favorite portfolio. Again, QQQs are down 4.8% for the year, S&P down 3% for the year, and our stocks are down 7.9%, just like the other portfolio. But this one actually moves faster to the upside than our All Stars portfolio. So let's go back to the dozen or so stocks in our NASDAQ 100, and we can see that last year it was up 47%. The year before it was up 98%. And over 5 years, now what's not shown here is 2022, when it was down about 34%. And the market was down about 20%. Market represented by the S&P was down about 20%. But over 5 years, which includes 2022, the down year, we're looking at this portfolio returning about 422%, with the S&P up 82%. So you can see that on the downside, it moves more than the market, but on the upside, totally outpaces the market. Now, we didn't have these 12 stocks in the past 5 years because we add and subtract some stocks at year end when we adjust our portfolios, and so some of these stocks change. And that's what you see in here. 5 years, 422%, the S&P up 82%. So we're looking at a 5 times return over the longer term. Now, let's look at portfolio protection. This is not the QQQs because I have QQQs up here, but we are instituting the same thing with the QQQs for our ETF portfolios. This is the SPYs. This is what we use for our 30 stock portfolio. And we buy, for a $150,000 portfolio, we buy 3 puts, and we space them out. Since we buy 3 of them, we space them out 3 months. So on February 21st, the put expired, and we went all the way out to May 16th and bought the 520 put. Why do we stagger them like that? Because as the market moves up, you can see that we bring up our protection. And this is protection about 12 to 15% below the market, below the recent highs of the market. So this is how we've been protecting our portfolios for years and years now. But now we're going to the QQQs, and let's see how that works. Well, first of all, I want to say the SQQQ is 3 times the inverse of the QQQs. So the QQQs, again, the NASDAQ 100, and we're going to use the puts on the NASDAQ 100, but I have this in here, and I'll tell you that as soon as I finish this slide. On February 21st, we rolled over our SPY puts, and the high was around 540 at that, right around that date, and we bought puts at 460, which was about 15%. So we're calculating at 15% below the high of 540. And right now we're kind of in between that, aren't we? We're on March 7th, midday, which is the day I'm recording this, the QQQ is at 482. So it came down from 540, and now we're sitting at 482. Now, the 460 put that we bought for protection is at $12, and we bought it for about $2. In fact, it's right up here, $2.20. So that put now is worth $12. So we gained, times 3 puts, we gained about $1,000 on each put. So that's $3,000. But the loss on the portfolio is about $16,000. But we didn't hit our 460 level yet. So in other words, these puts are gaining some money while the portfolio is dropping to our magic cutoff of between 12 and 15%. But if this is at the money, if we do go down to 460, because we're talking about the 460 put, we're not there, we're at 482. If it goes down to 460, it'll be worth about $19.50, or about $2,000 per put. Times 3 puts, $6,000. I don't want you to get confused here, just at the final numbers. The portfolio would be down about 15%. We would be up on our puts about 4.3%. Well, that's not exactly a hedge. But once we hit that 460 level, these puts will start going up dollar for dollar. So our portfolio, although not perfectly hedged, is hedged for not disasters, but for corrections like this, which happen about every year and a half or so, as told to us by one of the technicians on TV, and he also put it in writing in his newsletter. So in other words, we're waiting for that 15% correction, because if it goes down the market goes down 10%, it either stops there or it goes down to 20%. It doesn't seem that there's any in between there, and my research shows that. Doesn't mean it has to. We have no clue until it actually happens. But once we reach that point, that 460 put now becomes worth, if it goes down to 459, this price will go up to about 100. We're just approximating this because this is what we're looking at now. So at the 460, we do go down to 460, it'll be worth about $2,000. If it goes down to 459, it'll be 2,100. If it goes down to 458, this will be worth $2,200, and so on and so on. So then you really start going up. But I just want to point out that on the way down, you actually gain some money until you reach that 15%, and then you're hedged fairly much with the SPYs about $1 for dollar, with the QQQs a little bit less. You're hedged a little bit less than dollar for dollar. But the point is, if you go down 20%, at least you're going to make about 10% on your puts. And you're going, and if you go further down, you'll be worth even a little bit more definitely worth more on the puts. So at least it's some hedge on your portfolio. And where do we get the money to buy these things? Well, one of these 460 puts here, we sell covered calls maybe once a quarter, twice a quarter. We'll sell some covered calls on the stocks within our portfolio. We'll also do some call spreads on the way up, and just the little things like that give us enough money to buy these puts. And here the 460 put cost, while we were at 540, 460 cost about $2, but now look at it's worth $2,000. Good. So in other words, you multiply everything by 100. All right, now here let's go back to the protection that we use on the 30 stock portfolio. We want to start using the QQQs, because the QQQs, as we showed in one of the charts, move faster than the S&P 500. But now the stocks that are the top stocks out there in the universe really have a lot to do with the technical side of things, and they move faster both on the upside and downside than the general market. They move faster on the upside than the general market, a lot faster, but they move faster to the downside too. So rather than buying the SPY puts, we want to start buying the QQQ puts. And we showed you in the last slide, right back here, is that they can be worth some serious dollars once we get down to about that 15% level, and then they start moving dollar for dollar. So you're going to start seeing in our daily newsletters that we will be changing these to the QQQ puts as we go along. But right now we're protected pretty well with our puts on the S&P 500, and we're doing nicely out there, even though we don't like the market, and the market's going down faster than these puts, because this is like a deductible on your car, and that's how these puts work. So we want to be able to afford it. Now, if you had to insure your car for the full value, in about 2 years you could pay off that car. You'll save enough money. That's why you buy insurance with the deductible on it. It's the same with put protection on the market. In order to afford it, you want to buy with some deductible, and we can pay for those puts by selling some covered calls as we go along, as the market goes up. Even when the market goes down, we sold some covered calls because we knew the stocks would not be taken from us, and that's what we don't want. We don't want the stocks taken from us. So there you have it, folks, is that we can now protect our ETF portfolios because they move faster than the market, as we showed in the beginning here. So, folks, we had a pretty tough couple of weeks here. We're inside a correction here. Will we stop at the Dow 200-day moving average? Will the S&P hold it at its 200-day moving average? We just have to wait and see. Monday is usually a down day, and then we see actually a bullish day coming on Tuesday. So how bullish will it be? We don't know until we get there. So, folks, go out over this weekend. Take the market off your mind, because the market will be back here on Monday, and we will be back here with you within a few days. So, folks, take it easy. Stay safe. We'll see you in a few days.